10 California suburbs that once represented the peak of successful suburban living are experiencing significant housing market corrections in 2026, with price declines ranging from 10 to 19%, insurance costs doubling in some areas, and inventory levels rising to multi-year highs. And understanding what's happening in these communities reveals broader shifts in California real estate. Hey everyone, I'm a real estate market analyst. Before we dive into the suburbs, I need to be extremely clear about something. Nothing in this video is financial, investment, or real estate advice. Alright, let's start with number 10, Chula Vista. Chula Vista in San Diego's South Bay experienced one of Southern California's most dramatic pandemic-era price surges, with values increasing approximately 68% between 2020 and 2022. That growth was fueled by migration from Los Angeles and Orange County, low interest rates, proximity to military installations, and the perception of coastal access with relative affordability. By 2026, the market has corrected significantly. Median prices have declined approximately 14% from peak levels, and inventory has more than doubled year over year. What's driving this correction? Several compounding factors. First, the total cost of ownership has increased substantially even as prices have declined. Property taxes, homeowners insurance premiums, and HOA fees averaging $600 monthly have pushed total housing costs to approximately $4,200 monthly for median-price homes. That's beyond reach for many local families, even with the price corrections. Second, the military presence that once provided economic stability is seeing personnel relocate to lower-cost regions, including Las Vegas, Phoenix, and Texas suburbs. Third, builder inventory from the development boom is now competing with resale properties, and builders are offering substantial incentives, including solar panels, mortgage rate buydowns, and prepaid HOA dues to move units. Number 9. Burbank. Burbank has long benefited from its connection to the entertainment industry, hosting Disney, Warner Brothers, and numerous production facilities. For decades, stable studio employment and creative professional salaries supported consistent housing demand. 2026 tells a different story. Median home prices have declined approximately 13% from peak levels, and luxury properties in areas like Toluca Lake are experiencing extended market times with repeated price reductions. The entertainment industry transformation is affecting Burbank directly. Streaming service cutbacks, production budget tightening, AI integration reducing certain job categories, and increased production outsourcing have all reduced the employment base that sustained the housing market. Fewer new buyers with studio salaries are entering the market. Additionally, wildfire risk assessment in foothill areas has caused insurance premiums to double for some properties, with annual costs exceeding $10,000 in certain zones. When you combine reduced buyer pool, elevated insurance costs, and general property tax and maintenance increases, even affluent residents are reassessing whether continued ownership makes financial sense. Local businesses report declining traffic as homeowners reduce discretionary spending. The community that once felt vibrant and stable now feels cautious. Properties that would have sold quickly are experiencing months on market. The connection to entertainment industry employment that was once Burbank's greatest strength has become a vulnerability as the industry restructures. Number 8. Calabasas. Calabasas represents the high end of the correction spectrum. This exclusive community saw extraordinary price appreciation during the pandemic, with estates moving from $3 million to over $4 million in competitive bidding. 2026 has reversed that dynamic dramatically. Home values have declined approximately 18% from peak levels. Luxury buyers have largely disappeared, with many relocating to tax-advantaged states like Nevada and Texas. The cost of ownership in Calabasas are substantial even for high-net-worth individuals. Annual property taxes regularly exceed $35,000. Insurance for hillside properties now ranges from $15,000 to $25,000 annually due to wildfire risk assessment. HOA dues approaching $1,000 monthly, combined with private security costs and general maintenance, create carrying costs that even millionaires are questioning. Cash purchases, which once dominated transactions, have slowed significantly. Lenders are applying stricter terms even for high-income borrowers. The market psychology has shifted from exclusivity as an asset to isolation as a liability. Properties sit longer. Sellers reduce prices repeatedly. Some high-profile residents have quietly exited, accepting substantial losses to eliminate the carrying cost burden. Calabasas illustrates that even luxury markets aren't immune to corrections when the total cost of ownership exceeds buyer willingness to pay regardless of income level. Number 7. Tustin. Tustin positioned itself as an affordable alternative to Irvine, with modern developments around Tustin Legacy offering newer construction, contemporary amenities, and lower entry prices in neighboring communities. The strategy worked briefly. Young professionals moved in, prices climbed, and development sold quickly. 2026 shows the limitations of that model. Median prices have declined 12% year-over-year. HOA dues averaging $500 monthly combined with property taxes exceeding $1,200 have eliminated the affordability advantage. When interest rates increased and tech sector layoffs occurred, the buyer pool that sustained Tustin's growth disappeared. Many 2021 buyers are now underwater on equity, forced to rent properties at losses or hold hoping for recovery. Developers who built assuming continuous demand now face blocks of unsold townhomes. The rental market has softened as well, with units at commanded $4,000 monthly now struggling to lease at $3,200. The challenge for Tustin is that it offered affordability as its primary value proposition. When that affordability erodes through fees, taxes, and carrying costs while employment in target buyer demographics contracts, the market corrects quickly. Contemporary architecture and modern amenities don't sustain values when the financial math doesn't work for the target buyer. Number 6. San Clemente. San Clemente offered coastal Southern California lifestyle with Mediterranean architecture and ocean views. Properties that sold for $2.5 million at peak are now listing at $1.9 million or less in 2026. The correction here is driven primarily by insurance and climate risk assessment. Flood zone remapping, coastal insurance requirement changes, and elevated maintenance costs have fundamentally altered the ownership equation. Insurance carriers have either exited the market entirely or are charging 5-figure annual premiums for basic coverage. Homeowners who've lived in San Clemente for decades are reassessing whether coastal living justifies the financial strain. Utility costs for large coastal properties now exceed $1,000 monthly. Landscaping restrictions have increased maintenance expenses. Property taxes continue rising even as values decline. The combination is pushing out both long-term residents and discouraging new buyers. The second home market that once supported San Clemente has evaporated. Remote workers who bought for lifestyle during the pandemic now find costs unsustainable. Short-term rental regulations have eliminated that income option for many investors. Properties sit on market for extended periods. Sellers reduce prices weekly, attempting to attract buyers who remain cautious about long-term coastal ownership costs and climate risks. San Clemente's correction demonstrates that even premium locations face affordability limits when insurance and carrying costs escalate beyond buyer tolerance. Number 5. Santa Clarita. Santa Clarita, north of Los Angeles, grew as a family-oriented suburban alternative to urban living, offering newer homes, highly rated schools, and master-planned communities. Pandemic-era migration from Los Angeles drove prices up approximately 50% between 2020 and 2022. 2026 shows a 15% correction from those peak levels. In communities like Valencia and Stevenson Ranch, inventory has increased substantially, with builders offering aggressive incentives that still struggle to move units. The correction is driven by multiple factors. Insurance rates have increased more than 60% following wildfire zone expansions. Property taxes have risen with valuations. HOA fees exceeding $400 monthly have become standard. The total cost of ownership has increased approximately 40% since 2021, pricing out many families who could have qualified at lower carrying costs. Buyers who went under contract at peak prices are walking away rather than complete purchases on depreciating assets. Local businesses report reduced customer traffic as residents cut discretionary spending. The community that felt vibrant and growing now feels uncertain. Families who purchased thinking they'd found permanent homes are underwater on equity with savings depleted. Santa Clarita sold safety and stability as its core value. When insurance costs and carrying expenses undermine that financial stability, the entire value proposition weakens. Number 4. Please Anton. Please Anton in the East Bay represented affluent suburban stability, with golf course communities, executive homes, and proximity to Tri-Valley employment. 2026 data shows prices down approximately 16%, with sales volume declining nearly 50%. Tech sector layoffs that began in San Francisco have reached eastward, affecting Pleasanton's high-income stability. Companies that anchored Tri-Valley employment have paused hiring or reduced workforce, creating uncertainty even among affluent professionals. $1 million-plus listings in areas like Ruby Hill now sit for months where they once sold after single weekends. Cash buyers have decreased. Lending has tightened even for high-income borrowers. Mortgage rates near 7% combined with $9,000 monthly payments, $20,000 annual property taxes, and reduced bonuses have squeezed families who seem financially secure. Private school tuition that was automatic is now questioned. Some homeowners are renting portions of properties to manage costs. The market sentiment has shifted from confidence to caution. Properties sit longer. Open houses attract fewer serious buyers. The perfection Please Anton represented now feels expensive to maintain. The correction isn't panic-driven but reflects quiet reassessment of whether the carrying costs justify the lifestyle when economic uncertainty affects even hyenas. Number 3. Irvine. Irvine has long been Southern California's model plan community, with top-rated schools, immaculate infrastructure, and housing that seemed recession-resistant. 2026 shows an 11% median price decline, with condo sales down 40%. International buyers who once represented 40% of transactions have largely disappeared due to capital restrictions and economic conditions in source countries. Tech layoffs across Southern California have reduced the professional buyer base domestically. Developers are in damage control, offering mortgage buydowns, vehicle credits, and closing cost coverage to move inventory. Despite incentives, new construction blocks sit partially empty. The cost structure is challenging even with price corrections. HOA fees averaging $500 monthly, insurance premiums rising 25% annually, and mortgage rates near 7% create monthly costs that middle-class families cannot sustain. Many are relocating to Inland Empire communities like Corona or Mieta for affordability. Schools remain excellent and infrastructure immaculate, but the market has shifted from confidence to pressure. Properties in premium villages like Turtle Rock and Woodbury that sparked bidding wars now receive lowball offers, if any. Rental demand has softened with luxury apartments, reducing rents to attract tenants. Irvine's control perfection that once justified premium pricing now feels brittle as a buyer base that could afford that premium contracts. Number 2. San Ramon. San Ramon in the East Bay built its identity on corporate stability from Chevron and Bishop Ranch development, creating modern suburbia for tech and energy professionals. 2026 shows a 17% price decline from 2022 peaks, with inventory doubling. Properties in Gale Ranch and Windemo that drew multiple offers now sit unsold for months with $200,000 price reductions. Corporate relocations have slowed. Tech layoffs have thinned the buyer pool. Remote work flexibility that filled San Ramon during the pandemic has contracted as return-to-office policies tighten. Families who stretched for $2 million mortgages in 2021 faced $900 to $500 monthly payments before property taxes and HOA fees. The financial pressure is substantial even for dual-income tech households. Market sentiment has shifted quickly. Local businesses report reduced activity. Real estate agents describe shadow inventory, homeowners attempting to sell quietly before further declines. San Ramon connection to Silicon Valley success has become vulnerability as that sector contracts. The suburb embodied tech prosperity and now illustrates its fragility when employment and compensation tighten. And number 1, Santa Rosa. Santa Rosa in Sonoma County became a powerful comeback story after surviving multiple devastating wildfires, with communities rebuilding and prices surging on resilience and hope. 2026 shows a 19% value decline, the steepest on this list. Insurance premiums have doubled, with the state's FAIR Plan now covering 1 in 5 homes as private carriers exit. Newly rebuilt properties that symbolize recovery now sit unsold for over 200 days despite substantial price reductions. Insurance is a breaking point. Many carriers are completely withdrawn from Sonoma County, leaving homeowners with minimal coverage at triple previous costs. Combined with property taxes and utility increases, even financially stable residents are reconsidering whether staying justifies the strain. The emotional fatigue is significant. Communities that rebuilt twice are exhausted by the cycle of recovery and uncertainty about future fire seasons. Wine country charm remains with rolling vineyards and scenic beauty, but the market reflects exhaustion rather than optimism. Neighborhoods that represented triumph now feel frozen between pride in recovery and practical concerns about sustainability. Santa Rosa's correction is financial but also emotional, a community learning that resilience has limits when insurance markets fail and climate risks persist. So those are 10 California suburbs experiencing significant housing market corrections in 2026. What are the common patterns? First, all experienced substantial pandemic-era price appreciation that created vulnerability when conditions changed. Second, all face insurance cost increases driven by wildfire risk assessment, with some areas seeing premiums double, carriers exit entirely. Third, all show how elevated carrying costs through HOA fees, property taxes, and utilities can undermine affordability even as base prices decline. Fourth, all reflect employment and migration pattern changes, whether tech sector layoffs, entertainment industry restructuring, or remote work policy shifts. Fifth, all demonstrate that even affluent communities aren't immune to corrections when total ownership costs exceed by a willingness or ability to pay. The corrections range from 10 to 19%, representing substantial equity losses for recent buyers, but also creating opportunity for buyers with longer time horizons and financial stability to handle carrying costs. These aren't crashes in the traditional sense. These are market adjustments following unsustainable appreciation, compounded by insurance market disruption, elevated interest rates, and employment sector changes. For current homeowners, this data should inform decisions about whether to hold, sell, or adjust financial planning around carrying costs. For potential buyers, understanding what's driving corrections helps assess whether current prices reflect sustainable valuations or if further adjustments are likely. For anyone in these markets, the key is realistic assessment of total ownership costs, including insurance, taxes, HOA fees, and maintenance, not just purchase price and mortgage payment. In 2026, California suburban housing is being repriced based on complete cost of ownership in a higher rate, higher insurance cost environment. Communities are adjusting to that new reality at different speeds. That's a breakdown of 10 California suburbs experiencing major housing market corrections in 2026 and what's driving these adjustments. Thanks for watching. If you found this analysis helpful, let me know in the comments. Tell me if you live in one of these suburbs or if you're seeing similar patterns in your area. And if you want more content breaking down suburban market dynamics, price corrections, and housing trends with no hype and no fear-mongering, just data and analysis, subscribe to the channel. I'll see you in the next one.